My talk today is going to be the silver economy. Are you ready? So I'm going to do a little macro first, macroeconomics, and I'm going to run through these quite quickly. Global debt. This is a new milestone. Globally, debt has reached $315 trillion. Seems like it's setting a new record almost on a daily basis. What's maybe more important is the debt to GDP ratio, which is still at close to a record high, 333%. It's down from where it peaked in early 2021. But if you look at where we are pre-COVID, we're still above those levels, and it's just started to trend up once again. So certainly not a reassuring scenario. This is an interesting chart. U.S. total public debt, 1970 to today. And when I first started looking at this chart, what really sort of stood out at me was, first of all, these gray bars are recessions. And so as we come out of recession, you have government stimulus. And that, of course, adds to and increases the public debt. So what I noticed was that each time you came out of recession, especially the last three major recessions, so 2000, the great financial crisis, 2008, and then more recently 2020 COVID, each time we came out of recession, not only was public debt increasing, but it was increasing at an accelerating rate. And that's why you see these red arrows getting steeper and steeper and steeper. So more than likely, we're entering a recession very soon. That's my view, perhaps the next 3 to 4 months. So it'll be very interesting to see when we come out of that on the other end, what public debt looks like, how much it's been added to at that point, and at what rate it grows. This looks at U.S. debt to GDP ratio, 1965 to 2021. So what's interesting is in the 1970s, we were at much, much lower levels. We're talking about 35% debt to GDP, which obviously made it a lot easier for someone like Volcker, who was in charge of the Fed at the time, to be able to raise rates to kill inflation. Try and imagine that happening today, raising rates to 18 or 20%. Almost completely impossible. Back then, it was possible for even a matter of a few months. The debt being so much lower, the Treasury was able to sustain that for a while, pay interest at these much higher rates on debt in order to, as I say, to kill inflation. But you could certainly not have that happen today. The amount of printing as it is already just to service the debt is already off the charts. So imagine trying to see that at much higher interest rates. Highly unlikely that we're going to see those kinds of rates, at least Fed-determined rates, anytime again soon. Now, inflation is becoming structural, and I believe this is happening for a number of reasons. If you look at the period since the financial crisis, so say 2008 to about 2018, 2019, we had a decade of inflation ranging around 2%. But since COVID, and we've had this new giant wave of inflation, we now have these contributing factors. For example, labor, which has a much easier time negotiating with less people participating in the labor force, gaining and getting the salaries that they want. They have a much more bargaining power. Globalization, to some extent, has pulled back, in some ways has ended. You have a lot of supply chains that are now looking to source things more locally. They don't want to fall into the risk that they had when COVID hit, and all sorts of supply chains fell apart. The energy transition is another factor that's affecting inflation. We've got all these governments and companies that are moving towards net zero. Sounds like a good cause, but certainly comes at a cost. And so that's likely also going to, on an ongoing basis, add to inflation. And then the last one is defense spending. Well, we're looking at right now, a few wars are already ongoing around the world. Countries are getting more and more cautious and conservative, upping their spending budgets. So you have all these factors that contribute to what is likely going to be structural inflation that's going to be more in around the 4, perhaps even 4.5%, despite what we've seen in the last, say, last year or even 2, where it's come down. I don't believe that's going to be sustained. This chart shows the returns, the real returns on a U.S. 60-40 portfolio, 60 stocks, 40 bonds. Well, what's interesting is that if you look back at the periods that were challenged, the most obvious one is the 1970s, most recent. And during that decade, you had a -3% annual return and a net real return in that portfolio. So if we are indeed moving into a new inflationary environment, it's going to be a lot more difficult to produce real returns in your portfolio. And that's why I believe commodities that are an inflation hedge are going to be an important portion of any portfolio. This is also very interesting, long-term inflation expectations. So this chart goes back to 1998. So we're looking at about 15 years of history. And even during the financial crisis, you had only a short spike up to 4% where people were expecting that long-term inflation would reach 4 and stay there for the next sort of 5 to 10 years. Fast forward to currently, and even say 2019, 2020, it had fallen to historical lows. It spiked when COVID hit. And even when inflation peaked at, say, 9% or so back in 2022, you still then did not have higher inflation expectations like you have today. And back then, people were still saying, oh, okay, we're going to reach 3.5%, 4% over the next 5 to 10 years. There was this inability to, I think, kind of absorb and admit and expect that it was going to be on an ongoing basis. And now, finally, I think it has really sunken in for people. They do expect, and interestingly enough, that's with inflation having backed off recently. So it's quite telling that they now expect, on average, that inflation over the next 5 to 10 years is going to be somewhere above 5%. And so I honestly believe we're looking at what's likely going to be an inflationary decade, and certainly precious metals are the place to be in that kind of environment. If you compare the inflation in the U.S. in the 70s versus the last, say, 5 years or so, 7 years, what we know is that in the 70s, there were 3 waves of inflation. It didn't just come and then eventually go away. It came, it rose, backed off, rose again. So we had 3 successive waves like that. Now, you can't know for sure, but that first wave, which is that first red peak, backed off, settled higher than the previous trough, and then started to rise again. But after it bottomed, it only took about a year before it started to rise again. And if you use that as some kind of an analog for today, we may be only about 12 months away from a new, I hate to say it, but a new sustained rise in inflation once again. I don't believe it's absolutely gone at all. This I thought was interesting. I looked at this chart of the Fed funds rate and when they start to cut rates, which, as you all know, they just did this week with 0.5% cut. The red arrows show you the point at which a recession starts. So recessions start, the last 2 recessions at least. It's not a big data set, but the last 2 recessions started 3 to 4 months in from the first rate cut. So if we get something similar this time around, we're looking at mid-December, perhaps mid-January, before we actually hit officially a new recession. So all of this, in different ways, adds up to opportunity. And as you'll see, the silver economy is certainly something that you'd want to look at participating in some way. Now I'm going to talk about the rise of India. But before that, we've heard everything. We've heard lots about China, and it's certainly worth mentioning, but I'll touch on it very quickly. This red line is the demand for electricity in China. And as you can see, it rose pretty dramatically from 91 to about 2000, but then it absolutely took off. And, it's obviously an economic success story in many ways. The growth of their economy has just been legendary. I think that will start to slow down. And if you look at the U.S., the white line, the gold line is the EU. Those have been more or less sort of flat to, EU is flat to down, the U.S. is flat to up. But the green line at the bottom is India. And so, of course, it's much lower than, say, China's and even the U.S. and the EU's levels. But we've seen it grow the last few decades, and now it's starting to even head higher in at a steeper rate. Imports of silver to China. This is interesting because China is 80% of the manufacturing capacity for solar panels. I believe most of the silver being imported right now is going to solar panels in China. And this shows the 4-month change going back to 2009, so the last 15 years, where we just set a new record of imports of silver to China. Again, I think this is almost exclusively related to solar panels, the production of solar panels in China. Now we're going to switch gears and talk a little bit about India. India has the largest, it's expected by the International Energy Agency to have the largest demand growth for energy of any country over the next 30 years. And that's why I think we're going to start to see it catch up on China, for example. The chart is their renewable energy capacity additions. So comparing the brown bars of 2023, the gray bars are 2024. So we saw some of it is projections, of course, for a full year of 2024. But we saw a big spike in March. There was an announcement that India is going to have the world's largest renewable energy park. It's going to be 5 times the size of Paris. And so most of that's going to be solar. So they're really gearing up and looking to add solar capacity in India to meet their demand. Now, the forecast is that from 2023 to 2027, they're going to triple their solar module manufacturing capacity. That's still a fraction of what China has, but it shows you the trend that you can see happening in India. Their silver imports have been off the chart this year. February alone was 70.7 million ounces. That was 64% of the entire 2023 year in that 1 month alone. And if you add the first 4 months of 2024, you're already at a higher level than all of 2023. And that doesn't even include that spike, that darker blue bar that you see for August from this year, just reported recently. So imports of silver to India, again, off the charts. A couple of other things I want to touch on: AI and the new solid-state battery. Silver's uses, it's really kind of legendary. I call it a little bit like the Swiss knife, army knife of metals. It has just so many incredible uses. It's second only to oil as the most widely used commodity. It has over 10,000 uses. It's the most reflective metal. It's an excellent conductor of heat and electricity. Resists corrosion and oxidation. It's the second most malleable metal after gold. And of course, it has fantastic antibacterial and antimicrobial properties. Now, this is a statement by Sprott Asset Management, and they talk about silver and the AI implications. And they're basically saying that because of the rise of AI, the demand for silver is going to rise as well. And there's all these end-use applications that are AI-related that include transportation, nanotechnology, biotech, healthcare, consumer wearables, computing, energy storage, and data centers. And I'm going to talk about that last one a bit more. So this chart shows global data generated per year. So we all know we're, generating data, that we're really in an information economy. That's been the case for a while. And as the rest of the world modernizes, that's going to be the case even more. So between 2010 and 2013, there was a 60 times increase in the amount of data generated. That's the amount of data that we generate is now forecast to grow by 50% in the next year. And we're going to have in the next year more than all of the world data generated that was generated between 2010 and 2016. So again, this is a huge trend. Data has to be stored somewhere. That needs to be backed up. That requires energy. And then there's the AI implication that you can layer on top of that. So AI is that, just as I say, another layer of demand growth. The size of data centers and capacity growth from AI is going to be something really to be reckoned with. An example is that a chat GPT query uses about 10 times more energy compared to a Google search. And it's expected that by 2030, data centers alone in the US will take 7.5% of all US energy versus 2.5% last year. So it's AI is going to, data centers are going to triple their percentage of US energy demand. So all these big tech companies have net zero targets. They want and need to try to meet these targets. And obviously, you know, some of the best, an incredible announcement yesterday, I don't know if any of you saw it, but that Microsoft said they're going to restart the 3 Mile Island nuclear facility because they need the electricity for it. So, you know, net zero or close to zero emissions are really something that they're continuing to push. One of the fastest energy sources that you can get approved is solar. And this chart shows that all of the renewable energy projects in the US in the third quarter of 2023, the yellow dots are solar. So you can see that solar really dominates the new power sources in the US. And a couple words on Samsung's new solid-state battery. So obviously this goes into EVs. This is really probably going to be a game changer. It has an 800-kilometer range. It takes 9 minutes to charge versus, you know, much longer on current EVs. It has a 20-year lifespan, and it's 50% smaller than your current lithium-ion battery. Now, what's interesting in the silver side of it is that the anodes in this solid-state battery are silver carbon layered. Samsung has not said yet, but there have been some analysts who've estimated that this battery could require as much as 100 grams to 1,000 grams of silver per EV for that battery. So the battery is likely to go into what we call super premium EVs to begin with, because of course they're going to be expensive, but as you get adoption and economies of scale, you'll start to see them throughout the EV sector. So the reality of silver is that we're facing a drought of supply. This chart shows you the light blue bars are demand, the dark blue bars are supply, and I've highlighted in yellow that we've been in a deficit scenario, and that blue line at the bottom is the net of the two. And so that's been since 2021. We've been in a net deficit. That's forecast again this year. And if you add the deficits of the last 4 years, including what's forecast for 2024, we're at 759 million ounces. Just think about the fact that entire silver supply each year is 1 billion ounces. So we're talking about 75% of a single year's supply is the cumulative deficit of the last 4 years. Really something. Silver primary mines are already very rare, and this info from S&P Market Intelligence tells us that they think that silver from primary silver mines will peak in 2 years and start to fall after that. So where the silver is going to come from is anyone's guess. If you look at, now there's a lot of info here. This is from the Silver Institute's 2024 report, but it tells you all of the, or with some detail, a lot of the supply and a lot of the demand areas for silver. And so just some things to highlight. Between 2016 and 2020, solar was mostly averaged around 80 million ounces. And then 2021, it jumped to 89 million ounces. And then it blasted to 119 million ounces. Last year was 194 million ounces. That was a 64% growth in silver demand for solar alone from 2022 to 2023. And the forecast for this year is 232 million ounces. So we went from 8%, solar being 8% of all supply in 2020 to 23% this year as forecast. I think that forecast is going to end up being low. But again, we're in a deficit position. That doesn't look like it's going to change anytime soon. Silver mined throughout the world. The 3 biggest silver miners are Mexico, Peru, and China. Mexico is about double of either of the other two at 200 million ounces. Peru and China about 107, 110 or so million ounces. But this is very much in contrast to silver production. Silver reserves are much, much higher in Peru, for example. This is in thousands of metric tons, so about 1.1 million metric tons in Peru versus Mexico, which is the largest producers, which has only 37 million metric tons. So Mexico is producing the most, yet it has much, much lower reserves than 5 or 6 other countries. If you look at the combined output, Mexico and Peru over the last 10 years almost, that's fallen by 25%. The all-in sustaining cost globally for silver is roughly about $14. You have to ask yourself, if that's the case, at $31 today, they should be making money hand over fist, and yet why is mine production falling? Why are we not getting more silver out of the ground if it's so profitable? This chart is critical markets balanced for a number of critical metals, aluminum, copper, nickel, zinc, lithium, cobalt, platinum, and silver. Silver has the biggest deficit by 2030 forecast. We're talking about, hard to imagine, but 120% deficit in silver by 2030. So again, that's just not likely, but how that's going to push on silver is just going to be very, very interesting. Deliveries. Now, these markets are not meant to deliver silver, but that's how they've been handled and used in the last 4 years or so. You can see the last 4 years deliveries of silver out of the COMEX have been high and growing. COMEX down. The end of the arrow is when I talked about this the first time back in March. We've seen that they've continued to stay low and fallen in the COMEX. LBMA has stayed sideways. This is in London, silver inventories. Shanghai, they fell. They actually spiked a little bit recently, which is kind of curious, frankly, but they've stayed historically low as well. This is a really interesting statistic. In 2019, the above ground known silver supplies, if you just look at inventories on the exchanges, was good for 163 years based on forecast total demand growth. You fast forward to 2023, and that goes back to what I said back in March and I just talked about. We only have 2 years of above ground inventories for based on current demand growth. So it has just changed dramatically in a matter of 4 years. Silver is the next uranium. I've said this before, but this interesting quote from Jeff mentioned yesterday, Gehring and Rosenzweig. They had a few years back the single best performing and one of the largest commodities funds in the world. When I read this, I thought an amazing parallel for silver. They say 5 years ago, we became uranium bulls. The market had quietly slipped into a structural deficit with reactor demand outstripping mine supply. Fuel buyers used so-called secondary supplies to fill the gap. So that is, I believe, the exact same thing that's going on in silver. The big industrial consumers are draining the silver ETFs and the silver futures markets to get the above ground silver. This shows a world silver price, so an average of currencies from around the world. That's the gold line. The blue line is the US dollar silver price. So the gold line is what most of the rest of the world on average sees as the price of silver. They've seen it rise a lot more than we've seen it rise if we're watching the US dollar price. So a lot of silver holders around the world are, I guess you could say, maybe happier in terms of what's happened with the silver price for them. Running low on time, I'll try to make this really quick. Silver, when we've seen rate cuts start, has been up 32% over the next 24 months in the last 3 rate cutting cycles. From the bottom of the silver price, over whatever that period was, from bottom to top, over the last 3 rate cutting cycles, if you look at the bottom of the silver price, which was usually about the middle of the rate cutting cycle, silver averaged a gain of 332%. So what is it going to do in the through this next rate cutting cycle? Well, we will certainly have to see what it brings. This is the precious metals industry. If it were a single sector in the S&P, the precious metals miners are now the most profitable sector in the S&P with 40% cash flows, cash flow margins, just tremendous cash being generated. This is the gap between producers in enterprise value of gold equivalents and explorers developers. So as you can see, there's a big gap. I think that those cash flow margins that they have, that they're building up, is going to allow them to now start to step in and start acquiring and replace the reserves that they're obviously depleting. Silver miners and producers and developers are at near historical lows in terms of valuations. The red bar is actually showing that money has flowed out of gold miner ETFs, and that you've had a slight inflow of money into the silver miner ETFs, which is that small light blue bar in the middle. And if you look back over the last 5 years, you had an incredible spike of silver juniors to the silver price back in 2016. They returned something like 8 times what the silver price returned in a matter of about 7 months. We've seen that ratio bottom again recently. I think we could be entering a similar kind of period. So that's mostly it. I recently partnered with Jeff Clark of the Gold Advisor and Pater Prospector. You can get to understand the silver opportunity by honestly reading my book, The Great Silver Bull. You can find it in paperback, audio, and in Kindle. And if you want to follow my work, Silver Stock Investor Newsletter is the only newsletter that's focused exclusively on silver. And you can follow me at silverstockinvestor.com. Thank you for listening.